Okay, this is part 3 of working capital management, where we'll look at how to finance the current assets. So when we decide to finance the current assets, the company should consider the risk involved and then the return on the possible alternatives. So we'll look at 3 accruals, trade credit, and bank overdrafts. So accruals are just recurring short-term liabilities like wages and salaries, taxes like pay as you earn and VAT, and accrued interest. And this is a spontaneous source of finance. So it's you simply accrue wages throughout the month. So the employees work for 22 days or 30 calendar days or whatever, and you only pay them at the end of the month. So that's a short-term source of finance in the meantime. Same as VAT. You only pay VAT to SARS at the end of the month, even though you accrue the amount payable to SARS throughout the month. So this is expected to increase with an increase in turnover. So the more you sell, the more these accrual expenses would also become. So these accruals can't just be increased at will without increasing the level of the operations. But accruals are free forms of financing because there's no interest payable on the funds raised through these accruals. Then trade credit is a more formal source of finance where we buy from suppliers on credit. So there's agreement to pay at a later date. It's also a spontaneous form of finance, and it's regarded as free, as the interest is generally not payable on outstanding amounts, except if you go over the certain fixed terms that they offer. So, for example, a company buys 100,000 Rand of materials per day on terms net 30. On average, it would owe 3 million to its suppliers. So if they buy 100,000 Rand per day and only pay after 30 days, 30 days worth of 100,000 Rands would be outstanding at any given point in time, which is the 3 million balance of trade creditors. So if sales were then to increase by 50%, accounts payable will automatically increase by 50% to 3.5 million. So that's a generation of additional finance of 1.5 million, just by increasing the sales or purchases then by 50%. So extending the terms to 40 days would also increase the original accounts payable balance to 4 million, because now we have 40 days worth of 100,000 Rand per day outstanding. So the two ways to increase the finance through trade creditors is to either increase the amount that we buy or to increase the amount of days that we take to pay it. Now we've got an example to calculate the cost of trade creditor finance, which I'll also post in a separate clip, so you can click here on the link. If it's not showing at the moment, I haven't recorded it yet. If it's showing, you can click on it to go to that example. But you can try it in the meantime by yourself by using this formula for calculating the cost of trade creditor finance. So the cost of finance is the percentage discount offered for early settlement divided by 100 minus that percentage. So if it's 2%, it'll be 2 divided by 98. And then you multiply it by 365 and divide it by the additional days credit if the discount is foregone. The trade creditor finance cost that we've calculated with this formula should then be compared to other sources of short-term finance like the bank overdraft to determine whether we should rather borrow money from the bank to pay to get the discount, or do we just defer the payment to the creditor. The third source of short-term finance is bank overdrafts, where the interest rates are generally higher on smaller loans, and it's to more risky borrowers. A bank overdraft is a flexible source of finance and is often used as a precautionary or speculative source of finance. I mean, precautionary is when we run into trouble, we need cash quickly, so we use the bank overdraft, or speculative, so if we get a specific discount that's only valid for 7 days, or if we buy immediately, we can pay 10% less, then we can use the bank overdraft to fund that. Then the very last section, the advantages and disadvantages of short-term financing. So first, the advantages, the costs are usually lower. Like we saw with accruals, it's basically a free source of finance. It's fast, you can access it immediately. There's generally less credit checks and less formalities involved. There's no loan covenants or prepayment penalties. So if you pay your suppliers earlier, you won't get a penalty. Whereas if you have a long-term loan or a mortgage bond, sometimes if you pay it earlier, you get a penalty because the borrower loses out on the future interest that they would have received. And there's more flexibility, and you can more easily match the short-term financing with the short-term nature of the asset that you're financing. So if you supply credit to your customers of 30 days, you could try to match your suppliers and only pay them after 30 days. The disadvantages of short-term financing is the interest rates might be more volatile and fluctuate more frequently, and there's the risk of other borrowers not be extending you credit if you already use a lot of credit or short-term sources of finance.